Okay, so you're thinking, hey, yeah, but it's just a bank. We know banks. There's nothing. Let's talk about some fun stuff in the financial system. And fun stuff thing number one we want to talk about is shadow banking. So there are companies that act like banks but aren't banks. So a hedge fund. It's not a company that is in the landscaping business. Okay? There's a guy, and actually there's a Vegas story in all this, and I'll actually tell you the Vegas story because I know you're bored. There was a guy who was a math professor, and he's a math professor at MIT. Okay? And this is back when, his name is Ed Thorpe. This is back in the 60s when computers are the size of large rooms, and it was hard to get time on a computer. It's tough to get the computer to use. So he used to come in late at night, in the middle of the night, and he ran blackjack hands. Okay? So he was a gambler. He ran blackjack hands. He ran hand after hand and situation after situation of blackjack night after night after night after night. And he invented something. He invented something we call card counting. Okay? Yeah, math professor. He came to Vegas for a weekend in the 60s, financed by the mob. He was dumb enough to not realize he was supposedly not realize he was being funded by mobsters. But he came to Vegas for the weekend, and he made $70,000 in one weekend card counting. By the end of the weekend, his picture was up on every wall of every casino in Las Vegas and in Reno, and he wasn't welcome. But he went back home with something like $70,000, which inflation adjusted is close to $500,000. He made a lot of money in a weekend. Okay? Knowing he couldn't go back, he then wrote a book called Beat the Dealer, and poof, everybody knows how to do card counting, even though people are bad at it and the casinos have done things to stop you from card counting. Okay? So now what do? You did card counting, can't do that anymore. Well, you realize that out in the world, there are all sorts of things that are traded in markets. Everything from, frozen orange juice. If you've never seen the movie Trading Places with Eddie Murphy, you need to watch the movie Trading Places with Eddie Murphy, and you'll get the idea. Frozen orange juice, or wheat, or gold, or copper, or stocks and bonds. There's all these things that are traded in markets. Okay? Very often there's more than one market, or the markets have less information than they might. What that means is that a lot of times in these markets, the prices are wrong. The market is moving toward equilibrium, but it's not at equilibrium. You with me? It's either too high or too low, and it's headed toward equilibrium, not at equilibrium. To know that, you kind of have to know where equilibrium is and know where the price should be. Okay? So a hedge fund, and this guy Ed Thorpe, who invented card counting, invented hedge funds. A hedge fund is a company that takes a bunch of money from people, and then it finds prices that are wrong. Some of them are commodity pricing hedge funds. Some of them are stock hedge funds or bond hedge funds. They're looking for where prices are wrong. And they buy or sell things on the, I'll sell this to you a week from now. I'll buy this from you now. Okay? They're looking for prices that are wrong. If they think the price is low, you want to buy it now and sell it later. If you think the price is going to go down, you want to get someone to agree to buy it next week at the price you're paying now, right? So if I think that Apple is going to go down next week, I find somebody who thinks that Apple's going to go up next week. So if Apple's $400 a share now, and I think it's going to be $395 next week, I find somebody who thinks it's going to be $405 next week, and I offer to sell it to him for $400. So if I'm right, this guy just agreed to buy Apple at $400, right? I'm going to buy it at $3.95. I'm going to sell it to him at $400. I just made money, right? And he's going to lose money. Well, you can say, hey, he made money because he valued that stock at $400, but the stock is worth $405, but he only paid $400. I'm not going to quite structure the deal right. I'm going to play with him now, get him to buy the. So I didn't explain that very well, but the point is that these hedge funds are looking for prices that are wrong and then playing these markets. Okay? But to do that, they're taking in deposits. Sometimes they're making loans to people. They're making financial transactions that if they were a bank, the Fed would be on them watching them. But because they're not a bank, nobody's watching them. So there's all these banking activities that are going on in the economy that are unregulated. Okay? And that's a problem. And it's not little bits of money. It's, billions and billions and billions and billions and billions and billions and billions of dollars. Okay? Hopefully I didn't totally screw you up there. All right. There's also in our world things called dark pools. All right? So here you are. You're down there wearing your pink outfit. And you go to your stockbroker and you want your stockbroker just to buy you some shares of Apple. Okay? Now in your mind, you're probably thinking that your stockbroker gets on the phone or gets on the computer at his or her desk and they connect to the New York Stock Exchange in New York and they buy Apple at whatever the price of Apple is and you just got shares of Apple. Well, the chance that that's exactly what happened is really small. Really, really small. Like, really small. Now let me explain. There's two possibilities of what might have happened to you when you wanted to buy that Apple. And neither one of them is necessarily that good. So number one, ask yourself a question. How many stock exchanges are there in the United States? What do you believe? How many stock exchanges are there in the United States? Well, the last time I saw a fairly legitimate estimate, they claimed there were 43. And I would bet there's actually quite a few more than that. There's at least 43. Okay? So let's suppose your stockbroker here works for Goldman Sachs, or he works through Goldman Sachs, or that's J.P. Morgan's old building there on Wall Street. Maybe they never take that stock transaction to the stock market, to the New York Stock Exchange at all. Maybe it doesn't go there. Maybe it goes to the basement of their own building, basically. Okay? Now let's think about this. I'm a company like Goldman Sachs, and I have people who want to buy Apple and people who want to sell Apple. Well, the smart thing and again, there are a couple of thousand ways you can place an order for a share of stock. There's some very complex ways and some very simple ways. Most of the time people say, I want to buy Apple and I want to buy it between, $399.50 and $400. Okay? So when the order gets to New York, which should happen roughly at the speed of light, but it gets to New York, somebody goes in to buy that share. They look at the price of Apple, and if it's between $399 and $400, $399.50 and $400, they buy you the 10 shares you want, and there you go. That's the idea. Okay? But now, suppose that your stockbroker is a big company and they're kind of unscrupulous. Your stock company, your Goldman Sachs, they already own a bunch of Apple. They have a big portfolio and they've got a bunch of Apple in it. Okay? You put in an order to buy Apple anywhere between $399.50 and $4, They put in an order, some other person, some other client of Goldman Sachs puts in an order to sell Apple between $3.99.50 and $4. Well, if you're not scrupulous, if you have bad ethics, what do? Well, you go to the person who's selling the Apple and you buy it from them at $3.99.50 in your basement, and then you sell it to the person who's buying Apple for $4, and you pocket the 50 cents as extra profit on the transaction. So there would never be that big a difference, but the estimates are that normal people, you and me type normal people, pay billions of dollars a year more for stock we buy in the stock market, because most of these companies aren't actually going out and putting your trades into the stock market. They're buying and selling it in their basement, and they're coordinating their own customers, and they're making money off you. Okay? Now, that's not the only reason that you pay too much when you buy stock. There's another reason. So, the New York Stock Exchange is actually in New Jersey. They have their building in New York, but it's all really done on these computers in New Jersey. And that's the red arrow, the big kind of thick red arrow there. You have the funny looking stock exchange up there, but really that's the building on Wall Street. But really all the business gets done at this server farm down here to the right, sort of, which is in New Jersey. Okay, that's the New York Stock Exchange. Turns out that the New York Stock Exchange makes a boatload of money renting space for other people to put their servers in the same building with the New York Stock Exchange servers. Now, what's the advantage of that? Well, you're here in Las Vegas. It takes 4 or 5 milliseconds for your transaction to get from here to here, where these guys, it's virtually instantaneous for their transaction to get back and forth. So here's what they do. These guys are computer stock trading companies. Okay? All they do is buy and sell stocks. And in fact, most of these companies never own a share of stock for a day. So when they go home at night, when the stock market closes down, they have sold everything. They don't own a single share of stock. The next morning when the market opens up, they still don't own a share of stock. And they'll play the market if they find an opportunity to play the market, but they don't actually own stock portfolios. But they own computers that are in the stock exchange. Okay? So what they'll do is they'll put a small order for every share, every kind of stock that they think they can make money off of. They put a small order for that stock on these servers. So this computer tells this computer, I've got 10 shares of Apple to sell, or I've got 50 shares of IBM to sell, or whatever. Okay? Now you come in, your stockbroker doesn't usually send in a transaction. You want to buy 10 shares of Apple, that's not going to go into the stock exchange, right? Your stockbroker company is going to pool a whole bunch of orders from Apple, and maybe they've got orders for 1,000 shares of Apple. So they send this computer a note that says, hey, I want to buy 1,000. Well, the offer that's sitting there from you is 10. So instead of this computer automatically buying the 10, it sends a message back to this computer and says, they're selling 10. Do you want to buy that 10? Even though it's only part of your order. And then you go back and you say, yeah, I buy that 10. In the meantime, this guy saw that you wanted to buy 1,000 and they put the 10 here, but now they also put 990 here, but they offered at a higher price. And while you're going back and forth here, and those computers understand that this is happening in milliseconds, these computers are going back and forth. This computer rigs the market in those milliseconds. So when you come back, you're going to pay, maybe it's 1/8 of a cent more. You're going to pay some little amount more than you would have paid without that other server being there. Okay? That little server is making, maybe it makes an eighth a cent off of every share it buys, but if it buys thousands and thousands and thousands and thousands and thousands of shares, that eighth of a cent is going to add up to a lot of money over time. Okay? So we, the normal consumers, we're paying too much. We're either paying too much because we're trapped in somebody's dark pool, or because this computer sitting here is gaming the system by being right next door. And if you're saying, no, come on, a company paid $2 billion to put in a new fiber optic connection between Chicago and New York that was straighter than the old one and cut 2 milliseconds off of the transmission time. 2 milliseconds. 2,000th of a second faster than the old line, and it was worth $2 billion. And in fact, it was worth more than $2 billion because those guys made a lot of money off of that investment of that $2 billion fiber optic line. Okay? This, you and me, normal people, we need to play the stock market for the long haul. We need to be in the stock market for, in a mutual fund or something where we're in a group of people, and because we can't beat these guys. You can't beat these dark pool guys over here. You can't beat these servers sitting over here, right? We have to play the game way differently than these guys play it or these guys play it. And the system, the Securities Exchange Commission normally monitors stock transactions a second at a time, and all these things are happening in milliseconds. So a lot of this stuff that goes on behind the scenes and all this electronic stuff really doesn't get seen by the people who are supposed to regulate the stock market. Is that fun? Yeah, fun. Fun. Yes, there's more.